Thank you for joining today's webinar on the economic outlook for 2018. Today's program is part of NCPERS Center for Online Learning. The purpose of the Center for Online Learning is to provide remote continuing education for public pension trustees, staff, and other fiduciaries and stakeholders. For the past 12 months, the equity markets have been on a tear, and the broader U.S. economy continued its unprecedented ninth year of expansion. But there are questions facing us. Will 2018 be the 10th straight year of U.S. economic growth? Is the rise in the equity market sustainable? What is the impact of an unconventional and unpredictable administration? Who will be the next Fed chair? And beyond the U.S., what are the challenges and opportunities for growth in the global economy? These questions and others are what we hope to gain some measure of clarity over the next hour. Leading us in today's webinar is Dr. Stephen R. Malin. Dr. Malin is the director of Allianz Global Investors. As a strategist for the U.S. Capital Markets Research and Strategy team, he is responsible for making weekly U.S. and global asset allocation recommendations. His responsibilities also include analyzing global economic, financial, political, and regulatory developments for publication and to brief institutional, retail, and retirement clients. As always, we encourage questions and comments. However, in order to get through the presentation, we will hold all questions and comments till the end. The prepared portion of the presentation will last approximately 45 minutes. Additionally, today's presentation and other supporting materials are available in the handout section of the dashboard. We recognize today is Halloween, so hopefully Dr. Malin's presentation will be less about tricks and more about treats. Dr. Malin, the floor is yours.
Thank you so much. That was very, very kind. I'm not sure about tricks and treats, but one thing I am sure of is that there's a lot of things that need to unfold over the next several months for us to really get a clear view of where the markets are headed, where the economy is headed, and indeed where policy is headed. They all form one crystal that work together, and they are working together now in ways that are highly unusual. Perhaps the biggest theme of this entire presentation is captured in its title, and in two words in particular, in the word regime and in the word changed. So before I commence the presentation, let's spend a moment on regimes and changed. Regimes. We think of regimes typically in very political terms. There's the Trump regime. In China, it's Xi Jinping's regime, or in Japan, it's the Abe regime, or the three M's of Europe, Merkel, May, and Macron. And we think in political terms, and indeed they matter, because these regimes are unique to the last 100 years. They have a character to them that's very reflective of where we are in the world right now, politically, socially, economically, and in many other ways. But the word regime also has other meanings, and a regime is kind of a way of doing something and a way of thinking about something, and those are not the same thing. A regime is a way of doing something. Well, we're doing things now in ways that are really quite different from the way we did before. As you'll see in a few moments when we talk especially about the Federal Reserve and about the Congress and the administration, we'll see that the relationships have changed dramatically, and those relationships mean we just don't do things the way we did before. You don't have whips on the floor of the House and Senate trying to twist people's arms to do something in one way or another to vote for legislation. Think maybe about the most powerful of all who ever did that, which was Lyndon Johnson. We're not in a Lyndon Johnson era 50 years later. Or you think about the Federal Reserve and you think about its independence. And that independence is not only in jeopardy, it has already been compromised. And now the question is, do we go back to where we were before? Well, let's take a look at these regimes going forward, and this will be sort of the format for the entire presentation. But the second word I want you to pay attention to is the word changed. I thought a lot about that word. I wanted to say changing, and indeed it is. I think the important point is it really has changed. And the changes that are going on in the global economy, in the markets, are reflective of things we've never seen before, like a technological revolution of a proportion, of a ubiquity, meaning it's all over the world, that we've never seen anywhere like that before. Even the bringing in of electricity into factories and into homes will not have the same profound impact as what digitalization and some other things are doing. So in that context, we believe that the performance of the financial markets going forward, as well as what we've seen over the past couple of years, and maybe especially what we've seen over the past couple of months, are reflective of these new regimes, and the failure to understand them will lead to significant investment mistakes. So let's proceed by going to the first slide. And you see a quote, and it says, "For the first time in a decade, the world's major economies are growing in sync, a result of the low interest rate stimulus from central banks and the gradual fading of crises." You know what? We can look at the world growing in sync, and we can take from that a lot of implications. First theme I'd like you to run with is that while we believe the opportunities going forward, particularly in equities, remain very, very positive, we also know that it's happening at a time when the things that are giving us the positive outlook are also generating phenomenal risks. So ironically, at a time of accelerated growth in market valuations, we're seeing accelerated worry on our behalf about the risks. So what does this have to do with the word sync? Well, if the global economy is growing in sync, meaning synchronously at the same time, it's really a very positive thing. It tells you that global markets are expanding. It tells you that those companies that are selling, not just domestically, but in other parts of the world, are going to benefit from that. Because growing economies mean that you've got higher output and you have higher incomes. And that, in general, is a very good thing. It helps everyone from the financial institutions around the world to lend more and extend more credit in general, all the way down to the smallest companies that are looking for their sales base effectively to grow. But there's a problem here, and it comes really in the very same definition. Because if we are in fact growing in sync, something else is happening. Growing in sync means that GDP is growing in sync. And if the GDP around the world is growing in sync, it means that there's more output in sync around the world. And therein lies the problem, because the definition of economic growth is simultaneous growth in income and in output. And we know that what's happening is that output is actually growing faster than income is. That could happen because savings rates around the world are not only positive, they're generally pretty high. So we're watching this to recognize that while growth is a good thing, growth connotes more output. More output on the market tells you it becomes more and more difficult to write a scenario where businesses could have upward pricing pressure. So we watch this very carefully. Growing in sync, a positive thing. Growing in sync, creating a risk that it becomes harder for businesses to be able to make their higher prices stick if output grows faster than incomes do because of the savings. Slide number 3. The world economy remains in recovery mode despite some loss of momentum recently. Well, this is part and parcel of the growing of the global economy in a synchronous way. The chart on the left is, the chart on the left shows you a very interesting statistic. What we've done is we've looked at 4 countries or so, and we've taken their economic output that comes out regularly, and we've given it a score of 1, 0, or -1. 1 or +1 if it went up, -1 if it went down, 0 if it didn't change, and we're not interested in the magnitude of the change, only the direction. Well, one of the things you see in this macro breadth index, when you look at the right side of the left chart, is that those bars are pretty tall until recently, where it's starting to look like we're starting to lose some of that momentum. And there, again, tells you the mixed story. You want to see economic growth momentum because it means standards of living are going up and people are wealthier and their income is going up, and income disparities should begin to narrow. But it tells you, though, that if you're starting to lose economic momentum, maybe you have to start to ask whether or not at some point in the not too distant future, you start to lose earnings momentum. And if you lose earnings momentum, what then does that say about the outlook for the equities market in particular, the rate at which central banks change their monetary policies, and so forth? So we're watching that momentum very carefully. If we go to the next slide, which is slide number 4, it takes us into a world that we had never seen before, a world where so many central banks around the world had effectively said, we've got a problem. The problem is that there is insufficient liquidity in the market to assuage the fears of those who are the borrowers and the lenders. And we know that the interest rates are too high, at least that was the perception, to generate sustained economic growth again. So in order to get the economies to grow again, we need to put much more liquidity into the banking systems. And you see that just about every central bank in the world that really matters terribly much did that. Here in the United States, as you know, the Fed's portfolio, which grows because they put more reserves into the banking system. They are creating reserves, and with those reserves, effectively, they are buying securities. Their portfolio went to about $2.5 trillion worth of treasuries, $1.8 trillion worth of mortgage-backed securities, and the portfolio really expanded. But now we know that many of the central banks around the world have either started or intend to start to reverse that. So on October 9th, for example, the Fed here in the United States said, well, we're going to start to shrink that portfolio, which effectively means the amount of reserves in the banking system is going to shrink. And with that, you would effectively begin to see some of the groundwork being set for more permanent increases in interest rates, albeit very slowly, and slower growth in the money supply. You know, even though we've had the money supply growing persistently in the whole post-crisis era, Milton Friedman has not been totally disproven when he said that inflation is always and everywhere a monetary phenomenon. We just haven't seen that much inflation, but it doesn't mean that we haven't set the conditions that would be conducive to it if other conditions would change. Well, when you look at this chart, what's important here is that in the period post-2016, the amount of money as a share of world GDP that's in the monetary base tilts downward. And that says that some liquidity is being withdrawn from the markets, which then raises the question that's unanswered, but an important one. Is the withdrawal of this kind of liquidity exactly the opposite in its effects to what happened when it was put in? In other words, do we have a symmetrical impact from monetary policy such that driving rates down and building up the monetary base is matched in the opposite direction when you raise interest rates and shrink the monetary base? We believe that's not the case. We believe that's not going to happen. But we also know it's important to monitor this because the amount of liquidity that's out there provided by central banks will matter, especially if we go into a major kind of contraction in valuations, some sort of correction that's really powerful. The fear of the central banks, and it's one that we're watching as well, is really asking the question, if we get a serious correction, will the markets freeze up again? Will liquidity disappear even quicker? We don't know the answer to that, but it's the thing that we're watching very carefully. All of that said, interest rates are still very low, and the amount of liquidity in the financial system around the world is very great, and that continues to stimulate financial markets. So then comes the question, if all of that is true, is it even possible for us to be thinking about getting a sustainable growth rate in the 3 to 4% area? Again, we think that that's a very difficult thing to achieve. We've now had 2 consecutive quarters with real GDP at or near 3%, although the last number only counts 2 months out of 3, and we'll get more final numbers in a few weeks. But the point is, it's getting stronger. But you know what? In order to get sustainable 4% growth, there are factors that have very little to do with what the Fed does, and there are factors that will have very little to do with what happens in Congress with tax reform and other legislation. And specifically, The laws of economics have not been repealed. And we know that what is a sustainable growth rate really depends on two things. It depends on demographics, meaning potentially how many people and of what quality enter the labor force and stay there. And secondarily, it matters what your productivity growth is. Productivity has been remarkably weak, and it has been for a long time. And labor force growth has been remarkably weak. There are many ways of looking at that. On Friday, we will get a labor force participation rate number again from the Bureau of Labor Statistics. But one other way to slice it would be to say, of the entire population of the United States, how many of them are actually in the labor force? And that number is sub 60%. It's almost at a historic low level. So we're watching this carefully and asking the question, can you get sustained 3 to 4% growth? Will changes in tax legislation, will changes in Federal Reserve policy change the quantity and quality of labor, the quantity and quality of the capital stock, management practices, availability of resources? And we argue that it won't. So we could get real growth in excess of 3%, but whether it's sustainable or not is really highly debatable at this point. Next, slide number 6. What we are seeing, however, is that the eurozone seems to have a healthy economy going forward with some growth momentum. And that's important to note, because one of the things that is really important in an environment where you've got a lot of risk is the ability to hedge in certain ways. And one way to hedge is to hedge geographically. And we're now fairly optimistic that putting money into the European markets makes quite a bit of sense. From a value perspective, so many European companies were beaten down, did not have the kind of price appreciation we saw for equities in the United States. But more than that, we're starting to see a pattern in Europe where they not only are not don't have sclerosis, but they've picked themselves up, they've brushed themselves off, and the policy mix in different countries fiscally, as well as the policies of the European Central Bank with negative interest rates really have started to work. If that's the case, that's a real positive for U.S. exporters, and we're watching that carefully. It means that it puts some underlying strength under the euro relative to the dollar over time, which means you won't see rapid and sustained appreciation in the dollar relative to the euro, which is good for our exporters. And it tells us that the outlook for Europe is much more positive than it was a while back. You know, just literally a few months ago, you could have argued that every single bank in Italy is technically insolvent. Every one. We don't have that situation anymore. The banking system is a little bit more sane. The issues going on with Catalonia seem to be calming down, and because of it, some of the other issues in other countries that would have led maybe to some changes politically, with some breaking away of provinces and the like, that could have happened in Belgium, could have happened in Ireland, could have happened in other places. It's not likely to happen. What we are watching is the election coming up in Italy, where a far-right party looks like it's pretty strong, but in the end, we're impressed by eurozone having a healthy economy. What is troubling us is a statement like this from Daniel Tarullo, a former Fed governor. And this is a statement he made just a month ago. Economists do not at present have a theory of inflation dynamics that works sufficiently well to be of use for the business of real-time monetary policy making. Wow, we thought we knew how to generate inflation, and it just turned out that we didn't. We did not know how to generate inflation, and we see, if you turn to page or slide number 8, you can see where we are with this. One of the things that happened was we thought that flooding the marketplace with bank reserves would generate demand for credit across the board and a weaker dollar. We thought that interest rates would fall, and that falling interest rate would lead even further to more credit growth. And credit being on the asset side of a bank balance sheet would mean that on the liability side, you'd see money supply growth money supply growth would kick in and we would end up with more inflation. If you look at slide number 8, you see an interesting phenomenon. What you see here is a relationship between wage inflation and credit growth on the horizontal axis, two sort of measures of inflation potential. And on the vertical axis, you see core personal consumption expenditure deflator, or inflation, in the service sector. And it looks like a pretty good relationship. No, inflation has not become so profoundly unpredictable that we can't say now that we understand that we're able to generate service sector inflation. But what has changed, this is the new regime. What has changed is that when you look going back some 20 years at inflation, particularly for durable goods, washing machines, computers, flat screen TVs, cars, prices are actually 35% lower on average now than they were 20 years ago. We have deflated on the durable goods side, and we have deflated for a lot of reasons. We've deflated because of the growth of international competition. There are just more and more companies producing the same thing, and their prices have come down. Raw material prices have come down dramatically as well. Distribution channels have become shorter. This and many other factors explain why we've been able to drop the prices for a whole generation on durable goods. Non-durable goods like food and clothing, the prices have actually started falling and have been continuously falling on average since 2014. So the goods prices have been weak. The services prices continue to move upward at a fairly brisk pace. So, key point here. There's something that's happened in the world that has changed this. We don't see inflation crossing over all sectors at the same time. We don't see goods and services prices rising at the same time, and even within them, we've seen a change recently, even in the services prices, where there's been a drop back in some of the pricing for things like medical care and home health care. We're watching this carefully because the inflation dynamics around the world have been changing. Well, if they are changing, we're going to have to start thinking about the Federal Reserve and who's going to be leading it and what they're going to be doing. So Alan Greenspan said when he was chairman of the Fed, as you can see on the next slide, I don't think it's possible for the Fed to end its easy money policies in a trouble-free manner. Recent episodes in which the Fed officials hinted at a shift toward higher interest rates have unleashed significant volatility. Well, that may have been true in Greenspan's day, but it certainly hasn't happened now. We're of the view, and we think it's being played out in markets now, that volatility is muted and it's going to stay muted for quite a long time. It's not just in the equities market where VIX has 9 handles and 10 handles and occasionally an 11 handle. We're not seeing that much volatility really across the board. It could be, as you'll see in a moment, that people are just complacent. It could be that it's maybe the opposite of that. They're not complacent. They've made a judgment to stick with what they've got because they don't know what's coming, so it's better to stick with what you've got. There are many reasons for the low volatility, but one thing is clear, the Fed has not boosted volatility through a change in its policies. Well, part of the reason why we know this, you could see in page 10. And what happened is that when you look at this very complicated chart, the medium becomes the message. At the very top of the chart, you see monetary policy formulation. And at the very bottom, you see what the Fed is trying to do, which is change the level of aggregate demand, change the GDP. And in the process, maybe change the value of assets and maybe bring the inflation rate to a target level. But you see all these boxes and words? What it's really saying to you is that there are multiple channels through which monetary policy works, and it's complicated, and if there's a lot of places where things can go wrong, they will. And what ultimately happened was when you go to the very bottom of the chart, you see 6 channels: bank lending, private non-financial balance sheets, wealth, interest rate, exchange rate, and portfolio. What the Fed was able to do first, with their eyes open, with an expectation it would happen, is to get that portfolio balance effect very quickly. Ultimately, what happened was the wealth effect kicked in, and that is a lot of folks who had money to invest during a very long bull market for both bonds and stocks made a lot of money. So wealth accumulated. Its distribution was not across every single household, but the Fed got what it wanted. It got much lower interest rates, and it got wealth to build up in the hope that that wealth buildup would generate wealth effects and people would go out and spend it. They didn't. And that's where the frustration came from. So as we look at this going forward, it takes us to slide 11. We look at this and we realize that, hey, you know what happened? We got an awful lot of bank reserves out there, and the money supply just grew at a fairly steady rate. We never did get the inflationary growth in the money supply that we had feared. Let's go to 12. Neither did we get a really substantial growth in credit anywhere in the world. In fact, the oddity is that while there has been an explosion of credit in some sectors, meaning some governments, like the United States or China, some governments had massive expansions, but it didn't permeate households and businesses quite the way we thought. Again, it did in China, but it didn't really in other parts of the world. It's not like the trend growth rate of credit has been off the map. And if you don't get trend growth rate in credit that's lower than what you're actually achieving, it's very, very hard to inflate. So the Fed realized this, and the Fed stayed with a loose monetary policy as long as it could, until, if we go to 13, until, like China, a lot of decisions had to be made. And the decision that the Fed made was to take a look at how things were progressing and say, you know what, it's entirely possible that the laws of economics just weren't fully understood. That maybe there's a law of economics that says lower interest rates and more money supply generates more credit growth. More credit growth should result in more money growth, which should result in both more inflation and more real economic growth. Eminently possible. What in fact happened was that it didn't turn out that way. And now the Fed looked at it and said, maybe it's possible that the interest rates dropped below a level at which the economy would actually grow. That maybe when you reduce interest rates below what the Fed labeled the reversal interest rate, that instead of making the economy stronger, lower interest rates makes the economy weaker. And in fact, it distorts markets so much that we need to start making adjustments. Indeed, now that is where we sit in the week when a new Fed chair is going to be announced, because each of the serious candidates that are alleged to be looked at by the administration are consistent on this one same point, that interest rates got too low, stifled real economic growth to an extent, distorted the markets, and we'd all be better off if we set onto a path where interest rates rise towards something called R star, a neutral real interest rate that neither stimulates the economy nor holds it back. So whether it's Powell or Taylor or Warsh or Yellen, they're all of the same view, that the main strategy that the Fed must adopt and continue to hold to is to get up to R star, a target interest rate that will neither make the economy grow nor hold it back, because at current levels, interest rates are so low that they're actually impeding economic growth. It's for that reason that we believe, first and foremost, that the Fed will raise interest rates again in December, and that the new chair, whoever that is, and right now it seems to be down to two candidates, Governor Powell and John Taylor, whoever that is will stay on a course that will bring us toward that R star level. How high is that level? Nobody really knows, whether it's at 2% real federal funds rate or 2.25% real federal funds rate. Nobody quite knows. It's a moving target, but what we do know is that where it is now, between 1 and 1.25 as a target, is too low. So the one thing that you can sort of take to the bank with you is that the Fed will stay first and foremost on a course to try to get to R star. But now on slide 13, we're looking at China, and China's central bank is in a very different situation. They have a grossly over-indebted society, and they now have a brand new set of powers, not in the hands of the central bank, but in the hands of President Xi. What's important here to understand is that the Party Congress that just concluded just put an enormous amount of power in President Xi. But even more than that, it set up his power in such a way that he's unlikely to be challenged anytime soon by anybody. For the first time in anyone's memory, they did not set up a system or a set of names, actually, where you would imagine who would be his potential successor. Pretty much all the members of the Politburo, with basically only one exception, are his men and women, his choices. His power is really quite strong. The direction of China is very important, though. They will, from a central banking and a markets perspective, they are going to have to continue to deal with debt problems, especially the debt problems in their real estate market and some of the indebtedness at the provincial level. They've tried some tricks which have defied actually the rules of capitalism by taking debt and declaring it that it's no longer debt, it's now equity, and that changes somehow the balance sheets of the organizations, but in the end, it doesn't really change anything. We're watching that indebtedness very carefully, but what's very important is the less than subtle change that's going on with China focusing on self-sufficiency by 2025, with China focusing on getting much more open in terms of its financial markets going forward, with China focusing on, again, a very aggressive move toward its expansion of its service sector, and doing this in a way that says we want quality growth rather than just grow, baby, grow. That's not their intention now. And if it means the Chinese economy will grow slower, and if it means the yuan or the renminbi will be a little bit weaker, they're going to live with that. So this is a very interesting phenomenon to look at. Someone like President Xi, who arguably has probably the strongest mandate from government officials of anybody who's leading a country right now anywhere in the world except maybe Vladimir Putin. We're watching that carefully. And we're also watching Japan, as you would see on slide 14. The Bank of Japan is continuing to stretch its balance sheet, and it's starting to work. We're very impressed now with economic growth and the profitability of Japanese companies as investment opportunities. You know, it's not known very much and very widely that not only have we seen growth and a little bit more inflation in Japan, despite the fact that Abe and Kuroda, the head of the central bank, are committed to continuing to stay very, very loose in monetary and fiscal policy. What is not often recognized is the sheer profitability of so many Japanese companies. Indeed, they just came off a period where they had record high corporate profitability, something we hadn't seen in a while. And part of that profitability has to do with the new regimes that we're in, because Japan is the global leader, not just in things that we associate with Japan, like household electronics, but now in things like artificial intelligence and robotics. Japan is the global leader in these fields, and their companies are doing extremely well selling these properties literally internationally and taking leadership positions. That to us tells us that there's possibilities that are really positive for equities. Next regime. All successful revolutions are the kicking in of a rotten door, as you see on the next slide. John Kenneth Galbraith was the chief economic advisor to John Kennedy. But if you turn to number 16, you begin to see some issues with the tax proposal of the Trump administration, which, as you know, is wending its way through Congress. Every single day, there are new wrinkles to it. We learned yesterday that tax reform looks like it's proceeding well ahead of personal income tax reform. And even that looks like it's going to be significantly less expansive than had been hoped before. We now know that Congress, especially in the House, is considering phasing in a lower corporate tax rate to not get to the 20% number the administration wants, probably before 2022, to actually start reducing rates over a 5-year period by 3 percentage points per year. We know, for example, an issue that's very, very sensitive, which is the deductibility of business interest. Well, it's not going to happen full-blown the way the administration first proposed it. It's going to only be partial. And this is a big deal, because if you're cutting tax rates, it doesn't help you very much if you don't have terribly much income. And a lot of small businesses, and that's especially true in technology, don't actually have profits that they're booking. So they're growing and growing, but from profitability, it's not there. And without that profitability, a lower tax rate doesn't help them. But they also tend to be highly levered. And so if they're highly levered, what they want is continued deductibility of interest expense. If that's been compromised in some of the agreements that seem like they're coming out now from both the House and the Senate, that has profound implications, say, to technology companies, especially small ones. Just one or two other things that have emerged. This is on the individual tax side. Well, it doesn't look like we're going to get complete protection of IRAs and 401ks, but it also doesn't look like the tax benefits that we get from them will be totally taken away. So this is going to continue to be a source of negotiation within the Congress. And it's starting to look like Congress is paying a lot of attention to repeal of the estate tax. You know, the president came out in favor of a total repeal, but you know what? They can't do it because it's a cash cow. The problem that is being faced by Congress and is tying them up in knots is that there aren't terribly many big revenue pools they can tap. One revenue pool which they cannot tap is the benefits that maybe you and I get from our employer, like health insurance, and counting that as income. That would be politically not viable. We know they've been talking about what to do about the mortgage interest deduction. Well, it's starting to look like that's going to survive. The third big one that's sitting out there is not the IRAs, although that's a big one. The third one that's sitting out there is the deductibility of state and local taxes. The way things are moving as of this morning, it looks like the home mortgage deduction may survive, but the state and local income tax deduction may not. But I would warn that this changes every single day, and it's very hard to get your arms around it. But what it does say that's very important is that we are into an administration that believes it needs to kick in a rotten door. And so we will continue to see reform-type legislation entering, even if it doesn't come out of the Congress. And we're already seeing it in terms of the rollback of a whole variety of different regulations. My wife, for example, is an attorney for the Federal Trade Commission, and she can tell you that their regulatory roles have been shrunken already. What they choose to enforce, how they choose to enforce it, will permeate everything, and it will probably also permeate the Fed, because already there is a Trump appointee on the Board of Governors in Randall Quarles who is really, really in favor of rolling back of banking regs. Something to watch. One thing we've watched carefully is the lack of progress on infrastructure spending, which you see on 17. But the important thing here, just in the interest of time, I'll just make a quick point, is that even if you get infrastructure spending, the multiplier effect, in other words, for every dollar of infrastructure spending, how much does national income ultimately rise? It ain't a big number. Now, one could say that 2.5 in some cases is a big number, but it really isn't. The leakages that will come out of that means that if they were to spend $1 trillion on infrastructure, which they won't, you're not going to get $2.5 trillion worth of national income. A big deal, politically popular, basically will be handled by the states, but not a be-all and end-all. Slide number 18. Everything that can be invented already has. No, it hasn't, Larry Ellison, 1977, and imagine that's from the co-founder of Oracle. Number 19. In many ways, I think that this slide may be the most important slide in the entire deck. Technological change may yet be the biggest driver of productivity. Productivity drives growth. Productivity drives wage increases, and productivity drives economic and financial well-being. But you and I and the rest of the world are in the midst of the greatest industrial revolution the world has ever seen. And fortunately, the outlook for what this will mean for productivity, for new businesses, for job opportunities, and the like over the next decade is phenomenal. Unfortunately, what we're seeing now is that the early phases of an industrial revolution tend to take away output and take away incomes. So without focusing on all 6 of the words you see on the left side of 19, let's just focus on 1 or 2 of them. Dematerialization. That's an easy concept to understand. It just means you're using less material. Well, if you now have totally digitized, very, very sophisticated ways of manufacturing, you use less material. You don't waste as much. And then whatever it is that you do waste, you recycle. But it's different than that, because if you go from physical to digital, like we have with our iPhone camera, you don't buy film. And that means you don't buy paper to print out the pictures. You don't send it to a firm that does that for you. You don't even have to buy the camera. You've dematerialized. What about demonetization? Demonetization tells you we're able to do stuff now, and there's no money involved in it. It's effectively a marginal cost of 0. So you and I can talk via Facebook or Twitter or some other social medium to virtually the entire world if we want, and it costs us nothing. We can, if we wanted to, advertise at very low cost on social media and reach the same 6 billion people around the world. To go to 7 billion when we ultimately have that population won't cost us anything more. It means that businesses as well as people can produce outputs increasingly at a 0 marginal cost. If that's the case, we're going to be producing more. That's deflationary. And certainly, if we're producing at 0 marginal cost, that's deflationary. So we're watching this very carefully, because what's happened right now is this particular process has weighed on us, globally, affected output, and it has affected pricing. So just think about it in terms of what I like to call DANCE, D-A-N-C-E, data. The amount of data that's available is enormous and growing exponentially all the time, giving us access to information that not only gets us more precision in what we do, which is lowering of cost, but it also enables us to reach markets more precisely than we ever could before. Algorithms. It's very nice to have an algorithm, especially if that algorithm changes the world such that instead of humans helping or guiding computers, computers help guide humans. It works exactly the other way around. Networks. We're all familiar with a network like Facebook and how that grows and gives us access we wouldn't have before. The cloud, which does much the same thing. And finally, the way in which we exponentially improve what we do. We're so much better at doing so many things, whether it's something which I dare say is as easy right now as robotic surgery, all the way to the production of things through 3D printing, just so much more powerful. Meanwhile, it is dematerializing us, and it is also demonetizing us. We will turn the corner as we start to link together quantum computing and artificial intelligence and medical imaging and the like, and then we'll create new businesses, new occupations, and it will be a phenomenal stimulus to economic growth. In the interest of time, I'm going to skip a few and take you to the conclusion, and that is slide number 23. Risk-adjusted return maximization is the top investment goal. So we've looked out through our risk monitor that we do each year, and we ask investors all over the world, although this slide refers only to North America, about their investment goals and the things that they are most worried about. And you can see that the investment goals are not terribly surprising. They want a risk-adjusted maximization of return. They want absolute return. They want to outperform the benchmark. Nothing surprising here. But when you go to the right side of slide 23, equity market risk is on the minds of everybody. That just means that people in the marketplace know that valuations have been stretched and they're worried about it. Does it mean that they're necessarily going risk averse? No, it just says they're watching it very carefully. And as I mentioned before, in a world where algorithmic trading is so pervasive, you've got to watch that everybody doesn't go to the exit door at the same time. But what is interesting is that event risk came in second. This is maybe thinking about maybe North Korea, or maybe thinking about the impact of natural disasters and like, which often are man-made. And it's only third that you see interest rate risk. The activities of central banks are not really the biggest worries of investors that we're seeing right now. And so when you go to 24, we see, as you know, a whole lot of optimism in markets. Today, the Conference Board's Consumer Confidence Index was high, very, very high. We're seeing similar numbers coming out of both Japan and Europe. We're seeing CEO confidence being very high. And part of it is because leading indicators of what happens in the markets, both economic markets and financial, are really positive. If you go to 25, now you have to talk out of the other corner of your mouth. So remember, I started out by saying we're optimistic about the markets, but we also do it with a notion that risks are elevated, and one serious risk is market complacency for the four reasons that you see here: the low volatility, the high margin debt, the low ratio of cash equivalents to equity market cap, and just the low dispersion of earnings estimates. It seems like everybody's making money. We're watching that, and we're wondering when that complacency kicks off, will you begin to see a very rapid and very sharp contraction in valuations? That's not our forecast, but we know the risk of that is there. And finally, are investors overpaying for risk? You bet they are. Of course they are, but they're doing it with their eyes wide open, because in the end, what we're looking at is, if you go to 28, the fundamentals of Europe are very strong. That's what you see on 28 for the four reasons listed there. The fixed income markets, we know, have some issues coming up, which I'll get to in a moment. But more importantly, we're at a very interesting moment that happens only 1 month out of every 6, where we believe that because the business cycle is strong and earnings are strong, industrial stocks, including energy, could do very well for a while. That would be on the value side of the ledger. But on the other hand, the world recognizes this industrial revolution that I alluded to before, and it almost becomes irrespective of what happens cyclically, and so growth stocks tend to do better. So 1 time out of 6, you tend to see small cap, industrials, value going up at the same time that you see larger cap and growth going up. We think that that's where we are right now. And we believe effectively that equity investors around the world see it. And when you look at how things are going in Europe and how much better they are, as well as in Asia, we think that there are real opportunities for good things to happen. And finally, I'll just end with 29. We have concerns, as everybody else does, about the fixed income markets. We know the Fed is committed to raising rates up toward their R star. We know, however, that there's still problems with getting inflation expectations to be built into the way the fixed income markets are functioning. So in the end, we believe that, and this is almost a consensus view, we believe that the yield curve will continue to move up. That's a level. We believe that its shape will continue to flatten over the near term, because there's just not enough of a term premium, a growth premium, or an inflation premium to kick up the long end. In that environment, if you need to stay in fixed income with incremental money, we're saying stay in things that will take advantage on the short end of rising rates. something like floating and notes and the like. So I will end there. I said I would do 45 minutes, and I've done actually 50. I thank everybody so much for your attention. I hope that some of these comments are helpful to you.
Great. Thank you, Dr. Malin. We have one question. And the question is, at the beginning, you talked about how growth has been synchronized. Do you think if there is a contraction that the contraction would be synchronized, or do you think it would be uneven?
That's a question we've thought a lot about. I guess the way I would answer it is to say, yes, I do think a contraction would be synchronized, but, and it's an important but, that they may move in the same direction is one thing, that they would move in the same, the same magnitude is something else. So we think that what's going to happen is that because so much of what's happened around the world to stimulate the economy was a result of global growth in monetary accommodation, that the removal globally would contribute to that kind of contraction. But we don't think it's sustainable at the same pace everywhere because the economies are really in very different shape. So the answer to your question is yes, it would be synchronous, but in some places more severe than others. And key will be the extent to which you get a sharp drop that's followed by a rapid recovery that could take place, we believe, in certainly less than a month, maybe even in a week, because the fundamentals are still very strong for so many sectors of the economy.
Great. Thank you, Dr. Malin. Again, I echo your words to the audience. And when the audience members conclude this webinar, there will be a short survey. We ask you to take a few minutes just to finish that survey. And again, thanks again to Dr. Malin and to all, and we look forward to your attendance at the next NCPERS webinar. Thank you very much.